Good morning, everyone. I want to break down some price action on gold using a trade that I took earlier. I guess not today, but yesterday. I want to focus on the probabilities, how I use the probabilities to determine where my draw on liquidity is and where price is going. Alright, this is the change in state of delivery. It's pretty self-explanatory, but this is what I use in order to determine whether I'm going to be a buyer or a seller in that session. But it consists of a consecutive run of candles, whether here it's a bearish scenario, so it's up close candles. And these, once we close beneath these up close candles, I would consider this a change in state of delivery. And I would then be looking to be bearish, and I would expect price to continue trending lower. Versus the bullish scenario, the consecutive down close candles then get closed above. In this scenario, I'd expect price to continue trading higher, and I would look for continuation setups until we have a bearish change in state of delivery. Alright, so now I want the viewer to take a second to look at this chart and identify that we've been trending the past 3 days higher. So clearly from this chart, gold has been on an explosive run higher, and for a lot of people it would be scary buying it this expensive. They would rather pick tops and bottoms, and then for some people it would be easier to buy it when it's this far up. Both can make money, and put that aside and take a closer look at where we currently are right now. Ignore the trend, but with this recent 2 hours, there's a lot of down movement. It might be scary to buy that when it comes and makes this low. This is in replay mode, so this isn't live price, but this is at the time when I got into the trade. It was on this candle. The reason a lot of people might be bearish here is because we've taken out this buy side liquidity. It's a previous day high, and then we quickly rejected it with a large down close candle, leaving a large fair value gap and inversing some gaps. So a lot of people are probably looking at this and they're waiting for retracements to sell. Now it could pull back and it could enter this fair value gap and then go lower, but remember what I showed at the beginning, the order flow. The state of delivery is higher because we haven't closed beneath the consecutive runs of up close candles on this time frame. So all we really did is we pulled back to a discount PD array, which is the hourly fair value gap, which the body's closed within, and the hourly order block. Both of these are points of interest, key levels that I was watching at the time of this trade. Alright, now for the purposes of the video, I'm going to quickly go over the lower time frame. The focus of the video was the higher time frame and determining the draw on liquidity. So anything from this point on is not as important as what was in the beginning of the video, and I'm going to quickly go over and summarize what then happened from the lower time frame onwards. But we have 2 sweeps here. The first sweep at this time, the second sweep at that time. Now this was a really bad sweep. We initially came down, you'll see on the 1 minute chart. This is not a bad sweep here. The targets that I was using was this short-term high and then this short-term high. Both areas where there were fair value gap lows on a higher time frame. Now this is my entry time frame, the 1 minute chart, and I have my execution shown. So I got in on a first trade after the first sweep, but you see what's wrong with the sweep. We're really not that active. Price is not moving too much. It's leaving no fair value gaps. There's no inverse fair value gaps. And so the probabilities are lowered. I do know that, so I do enter with 1 contract instead of a bigger position, and it was a paper trade, so I didn't really care. As long as the model was there, I was just going to take it. And then we sweep the 5 minute low there. I do get in prematurely before the fair value gap inverses, but this time I do see we have bearish fair value gaps. So I'm excited because I know that price is starting to be more active and it is in a position to spool. Then I have a second entry, which would have been part of this would have aligned with my model, a trade back into this fair value gap, and then an entry here. Anyways, I take off 2 contracts at the short-term high buy side liquidity, and I take off 2 more at the next short-term high. Well, this isn't a short-term high on this time frame, but this buy side liquidity up here. So this would be an intermediate term high, another intermediate term high, but on the higher time frame, they're short-term highs. Anyways, that's it for this video. So thank you very much for watching. It's a simple video. Hopefully this may have helped someone. But anyways, I will see everybody in the future.